Good morning, ladies and gentlemen, and welcome to this is our seminar on understanding the risk and reward equation. This is a subject that AHDB has addressed at each of the BP shows over the last 3 years, and it is very much a question that the industry keeps posing to us. Today our session will be sort of a combination of presentations and then followed by a panel session to finish. The panel session will be chaired by our first speaker, which is Neil Cameron. Now, Neil Cameron is a senior consultant with Bidwells, Farm Business Consultants, and Neil has been instrumental in developing the benchmarking initiative that AHDB has been involved in for some years. Built into the arable benchmark model is some comparative data. And it is this data that Neil will report on. It is model data that represents upper quartile performance for each of the sectors that we publish the data for. The data will be available within our arable benchmark model from the 1st of January. So if you download the model from your existing registration or your new registration, then you will see what the new cost profiles are. So if I could ask our first speaker, Neil Cameron, to take over from me. Could I just remind you, please, to turn off your mobile phones, and the session at the end will have a roving mic floating around there with Mr. Burgess or Mr. Davis here. Thank you.
Good morning, ladies and gentlemen, and thank you very much for giving me the opportunity to be here this morning to speak to you again. So this morning we're speaking about understanding the risk and reward equation in the potato industry, and in particular looking at the cost forecasts that we produce for British potato production. So as Phil says, we produce this data annually with the Potato Council. We do it as Bidwells in conjunction with Anderson's, so we get a good cross-section view across the industry on how things are changing. This morning what I want to talk about is how we see costs changing over the last year and forecast for the coming year, what's driving those changes, a little bit about monitoring and managed cost of production, where things are going to go in my big crystal ball, and then a little bit about what success looks like. So apologies for those of you who've listened to me present about this before, but it's quite important that whenever we talk about cost of production and model and forecast costs, that people understand the context that we look at. The potato industry, as all of you will be more than aware, is a very complex industry. And in my mind, it's much more difficult producing the sort of data we do in the potato industry than it is in other sectors, where the product that's produced is more a more even product. So with the potato industry, we've got a huge number of factors that affect the cost of production. So we've got variety. We work with a huge number of different varieties, and we've got supply period. We've got crops that are lifted fresh off the field. We've got crops that are stored for 6, 7, 8 months of the year. All of those things affect individuals' cost of production greatly. So whenever I sit down with a group of growers and look at cost of production, we rarely find two growers who've got costs that look at all similar. There's lots of complicating factors. So to produce some data of relevance, we've got to do a little bit of standardization. We've got to sort of make a few assumptions. Okay? So what we do is we take a stab at looking at a mix of mid-term storage crop and off the field to give a little bit of context to where we're looking. Obviously, if you've got longer-term storage, if you've got very early crops, you've got to look at how your costs would be different. You've got to use the data in context. The most important thing to me is using it as a guide to how patterns are changing. So if you look at the data year on year, the general trend should be similar for different growers. Different factors influence different people more or less. We also have to make some assumptions about standardizing costs between businesses. So one of the things we do is we include a market value land rental across the entire potato crop area. So the land, whether it's your own or whether it's land you rent in, we put a rental value against it. We also put in a cost for family labour, and we put it in a cost for capital as well. And that equalises between the tenant and the landowner, between the business using family labour and the business employing a high proportion of their labour. Really important, the most important point on there is the bottom point, which is use this information as a guide, as a trend to how things are changing in the industry. But most importantly, use it as an opportunity to go back and look at your own data and understand your own costs or the supply chain you're working in, because that's what really matters. And if you're getting figures that are varying greatly from what we're doing, by all means come and talk to the Potato Council ourselves and see if we can understand why that's happening. But what's most important is that you actually understand your own cost of production, what makes those costs up and why they're changing. So one of the slightly disappointing things from a consultant's point of view doing this data is it's actually been a little bit boring over the last couple of years because we haven't had the huge, great big swings that we saw a few years ago. So it makes it a bit harder to find a headline whenever you stand on a platform like this. But there's some underlying trends that are important nonetheless. So on the whole, costs have been a little bit more stable for the last couple of years, and maybe that's a good thing for an industry. Fertilizer prices have softened. Fuel prices have dropped sharply, and we'll look at some graphs of those things in a minute. And the euro exchange rate has had a big impact. So this is a graph of over the period of time that we've been looking at the data. We produce figures for wear and also for processing. And the figures on there, the bar charts are for cost per hectare, and the line are for cost per tonne. And although it's quite a small change, we're looking at a change of between 1% and 2%, about 1.5% reduction in costs that we're looking at for 2016 compared to 2015 as our forecast. So some of the things that go in behind that, fuel and electricity. Fuel prices, I hope any of you who are buying fuel are more than aware, fuel prices have dropped hugely, very, very sharply in the last few months. The oil prices dropped, and on the back of that, the diesel prices dropped, and that makes a big difference. But the important thing to realise is that although that single number has dropped a long way, the actual overall impact on the business is reasonably small, so it only has a fraction of a percent on the overall business. But it's been a fundamental change, and that's been great. Electricity is a little bit more surprising because if you look at electricity or retail electricity prices, they've actually stayed very stable over the last few years. If you look at wholesale prices, so that's the prices that are traded at industrial level, they have fallen significantly. And so really, we'd be expecting to see some drops in electricity prices at a retail level, but they don't seem to have come through yet. Fertilizer was the factor that back in 2008 really set the whole sort of cost of production thing on fire and really changed our costs hugely, significantly in the space of a month or two. Since then, we've had a more stable pattern. On the whole, price has been a little bit flatter. What we've seen with nitrogen prices in particular in the last few months is that they have dropped, and that's made things a little bit cheaper. So again, that's one of the other drivers of a little bit of cost reduction at the moment. So there we are. So future trends. So this is the bit that's always difficult. People say to you, what's going to happen in the future? Well, all I can do is look forward and make my guesses, but there's some things that I think are important for people to consider. One very important topic that you need to be aware of and thinking about is labour cost, because there's a couple of things that are going to change labour costs for a lot of farming businesses. We've got pension rules changing, where it's going to become compulsory to put pension provision in place. And a lot of farming businesses we look at won't currently have pension provision in place for all of the workforce, in particular casual and shorter term workforce. So that's something that's going to impact, and that will have quite an impact on your labour costs. Also with the minimum wage rules changing, again, particularly when you look at casual labour costs, that's going to be quite a significant number of people. Now, looking forward over the next 12 months, those factors don't really come into it for most business in the next 12 months, but when we go another 12 months ahead of that, that will be coming into the equation, and that's one to be planning for and looking at as you go forward. Oil, again, is an interesting one. We've dropped back at the moment. Where are we going to go looking forward? The oil price as it sits at the moment has really discouraged investment in the industry. Anybody living up in Scotland will see that in Aberdeen there's been a lot of people laid off, a lot of subcontractors put off jobs, that the investment in North Sea oil has shrunk hugely. And the same is being seen in North America. So one of the big drivers of the oil price reduction has been the availability of shale oils in North America and turning America from a very big importer of oil into an exporter. But their investment there has been slowed down because the oil prices at the moment don't work for those sort of relatively expensive areas. And that means that we will see maybe the power balance shifting back to some of the Middle Eastern and OPEC countries. So there is the potential for oil to climb again in the future. Exchange rate is something that's played quite a big part for us. So The most obvious thing for all of us is single farm payment, and exchange rate has shrunk single farm payment significantly over the last 3 years. It also affects the viability of bringing material into the country or competing potatoes into the country. It also affects machinery prices. So you would think at the moment the exchange rate should be working a little bit in our favour with new machinery prices, which it maybe is, but we're also seeing a big softening of second-hand values. And when you start looking at the net cost of replacement, there isn't as big a difference as you might think when you just look at the new value. So again, that's something to think about. Okay, so having looked at how costs are changing, it's important to say, okay, what can you do about that? So I would encourage you, again, and my message always is make sure you understand your own costs and make sure you understand how those sit against the customers you're supplying, the value you can drive for your crop. It is important to be profitable, but it is also important to be competitive. And sometimes maybe as an industry, we focus very much on trying to change our output prices, looking at what we can achieve there. But at the end of the day, we've always got to stay competitive. We've got to be competitive, and our customers have to be competitive. If we want to sell potatoes into a market, they have to be of value to the consumer and at a fair price compared to what somebody can do with an imported crop as well. So we need to make sure that as an industry, we continue to strive to be competitive. Level of performance compared to other growers out there. Farming is typified, and slightly strangely, by the range of cost of production we see. It is very common when I sit down with a group of growers to see cost differences of more than 30% between growers. 30% is a huge difference. 30% profit margin would be a lovely level of profit to have in producing potatoes. Well, if we've got a 30% difference, either somebody's making some good money or somebody's losing a lot of money. So there are huge differences in the industry. And you need to make the decision about where you want to sit. You need to decide whether you want to strive to be in that upper quartile. And the first question is, do you know where you sit compared to other growers? Do you know how your performance compares? And what are the factors that make you sit where you are? The overall driver is technical efficiency. Yield production in potatoes or yield of potatoes that meet your customer's spec is the overall biggest driving factor in cost of production. If you can make your crop yield at quality, then you will drive your cost of production per tonne down above any other factor. After you've done that, you need to look at how you manage your inputs. So think about the costs and the drivers of cost. Think about whether you're making enough money to invest for the long term. I strongly believe that a successful industry needs to be able to make enough money at all levels to invest for the long term. It's one thing being able to produce potatoes today and put a crop on the shelf. It's another having an industry that's fit for purpose in 5 years' time. And we all need to, wherever we sit within the supply chain, look at that. We need to look at risk management, and some of the other speakers are going to speak about risk later on. But risk management becomes a balance. You can manage risk by putting cost into your system, but if you manage every risk and over-manage every risk, you'll manage your profit out of the system as well. So with every decision you make, whether that extra blight spray goes on, how much you use a nematicide across the crop, how much machinery capacity you have, each one of those decisions, every day as a farmer, you're making a decision about how much risk management do I put into the system, how much comfort do I build into the system, and what value does that have. But against that, you've got to balance that cost. It's easy to stand on a platform and highlight it. It's slightly more difficult on a day-to-day basis to actually make the decision where to sit. And finally, strong market relationship. Make sure you know what you're producing it for a market. Okay, so Phil already introduced me and said that we've been working with the Potato Council on benchmarking. The Potato Council provide a benchmarking tool on their website. The data that we produce here gets fed into that tool, and you'll see it in there as the comparative data. I can see a number of you around the room who've done benchmarking exercises with us, and that's great, but I encourage any of you who haven't to go and do that and look at your business. So, in conclusion, potato cost of production, as a reminder, it has gone down a little bit in the last 2 years, but it has gone up significantly over the last 10 years. We're sitting in a very different place to where we were sitting 10 years ago with cost of production, and we need to remember that. The industry has changed over that period of time. but in the immediacy, costs are going down a little bit, which has got to be a good thing. I think we're in a period of slightly greater price stability for inputs, but we're seeing more volatility in the last few years in output price, and that's the bit that's having the big impact on us at the moment. Consumer demand, which there have been other presentations about during the last 2 days, consumer demand is a big factor for us. And as an industry, we need to think about where our crops are being sold, how we convince the consumer to eat a strong amount of potatoes in their diet. So consumer demand and the strong pound will both put pressure on us in the short term. We need to try and make value from the crop. We need to look at what we can do with potatoes, how we market them to get more value to the industry. And lastly, my key message, I think, is always look for technical efficiency, look for excellence, try and strive to be the best grower, the top quartile grower, because that's where you get your profit from. Okay, so thank you very much for giving me the opportunity to speak to you. I'm going to hand over to the next speakers now, and then we'll have a question and answer session. Thank you.
Thank you, Neil. Timekeeping was excellent. Gordon spends his life looking at risk, evaluating it, and more importantly, quantifying risk. He spent a considerable amount of time last night at dinner explaining a banker's view of how he actually makes decisions. And he's going to share some of that with you today, assuming we've got a presentation at the back there. So let me introduce to you Gordon Whitford. He is the Regional Agricultural Director for HSBC. Thanks, Gordon.
Thank you for that. No, it's okay. No doubt, Phil, I bored you last night. So I will be, as Mark kindly led me down the path of reinforcing some of Neil's comments. One or two of our slides or comments will be the same. So to start off, when a bank comes out to see an individual business, the one question it's trying to answer is, will your business be successful going forward for the next 12 months? And basically, successful to me and to the bank is, will your business generate surplus cash to pay all costs and leave you in a better position than you were 12 months ago? Quite clearly, if you've got capital expenditure, you place that on loan account facilities. It's the business current account that gives us a great deal of indication of how that business is performing. But if there are problems in a difficult year with weather, with oversupply, or with the general economics of the UK industry, then successful going forward does change, and that's about mitigating the cash negative position which some of the sectors have suffered at the present moment in time, and which potato industry has suffered in the past. Oops, one too fast. So coming on to the points that Neil was making about exchange rates. So the graph up there is the total income from farming, which is basically an indication of profitability of all UK agriculture. And you can see in 2014, the figure of 5.37 billion is the return that the government believes that agriculture generated as a profit. With an exchange rate of 73 pence, total income from farming may fall somewhat. And the reason why I say that is that the main reason why I want you to look at this is the red line, which is the sterling-euro exchange rate over that time. And there's a great correlation between sterling-euro exchange rate and the returns to agriculture. So therefore, only reinforcing what Neil was saying, that exchange rates will have an impact on the returns to agriculture going forward. The bank's chief economist believes that the exchange rate may improve to 76 pence this time next year, which is slightly alleviating the problem, but still providing a tiff if the correlation continues at sort of 4.2 billion pounds, some 20% lower than 2014. The main problem is if we stay in the EU, the euro is not going to get strong in the short term, according to our economist. Therefore, price pressures will remain on all agricultural sectors for some time. What the bank's also looking for is what's happening in your own individual sector. And this is some data from Eurostat. It is sort of 12 months behind, but it gives us an indication of what's happening for demand in each sector rather than income. So as you can see in the top left-hand corner, we're seeing the businesses that we are seeing growing in the UK, such as strawberries, pig meat, chicken. Pig meat under slight constraints at the present moment in time, but still not seeing the difficulties that other sectors have seen. The bottom left-hand side, we're seeing dairy and wheat, where our production is increasing in Western Europe, but in the UK, the share that the UK has is declining. And you can quite clearly see where potatoes lies. It's in the box where the UK is losing ground in a declining market. That puts more pressure on those businesses acting in that particular sector. If somebody wishes to grow, that is usually at the detriment of either exports coming in, which against an exchange rate makes it more difficult, or someone leaving the sector or reducing supply. So how do we assess a proposition when it comes in to HSBC? We're looking at three key elements, and in that particular order. We're firstly looking at management, because that'll be the main driver of any business and is one that makes it successful or not. So we're looking at the key drivers. What experience have they have? Where have they come from? Have they developed that business over a trend over a number of years? What is the second tier management like? Has that got the experience and skills to step up should anything happen to the key drivers? And in particular, we're looking at succession. Do they have the skills to take over from their fathers or within businesses? And if they don't have the skills, what is the business doing to improve that position? Will they bring in the skills from outside, or will the succession go out and develop the skills through training? Affordability. When we talk about affordability, we are looking at cash. It is about positive cash flow. So the main items that we're looking for when we come out to see customers, we're looking for cash flows, we're looking for accounts, we're looking for costs of production, we're looking for how you benchmark yourself, we're looking for budgets. And the good, successful businesses will provide that information at the interviews when the bank managers turn up. The other source of information we have, which is our own information, is the conduct of the current account. Quite clearly, if a business is cash positive, the current account activity tends to improve, unless there's capital expenditure that we know about. But for some appointments, all we will have is the bank balance. Some customers do not provide the information, and therefore less likely to obtain the funding they're looking for as quickly as perhaps they would, without the need for going back to their own professional advisors to provide what the bank requires. I've put security on there. It is a second source of repayment, and I don't intend to say a great deal more about that, but I left it off. Someone in the audience would mention that would be a bank requirement. So what are the banks looking for? They're looking for the top 25%. Neil mentioned the top quartile. It is exactly the same sector. We're looking for the progressive businesses generating cash in normal years, accepting that at times they may be cash negative if there's a significant downturn in the sector out of their sort of control, but as long as they're minimising what that lack of control may bring to their business. Volatility appears in every sector. It has done so in potatoes in the past. I've been with the bank for 25 years to realise what sort of prices you can receive. And this could be any product, but we'll call it potatoes for this particular time. Clearly, times of high returns and times of low returns. And why do the banks want to monitor volatility, and how do we manage to assess it? It is based on your unit costs of production. So that is back to the benchmarking that Neil talked about. He talked about a 30% variation in peer groups. I suspect that variation is significantly higher between the best and the worst in each peer group. And I do ask a lot of my customers, where do they fit in that graph? Are they the red line, the high cost of production? Are they the green line? The best customers are clearly towards the green and towards the medium. They know where they are. They know their cost of production. If I go to a high unit cost, they will not have a clue where they stand in that market segment, and they're leaving themselves open to issues going forward. Clearly, some high-cost unit producers can survive. They have that unique market. They have that better return that they may be selling and cutting out the middleman. But I do believe that every business should understand where it is in that competitive marketplace. Is it top quartile or is it bottom quartile? And if I asked everybody in the room today, would they know in that sector which line they would be most closely aligned to? So what do we see the best do? We do believe that benchmarking and budgeting are essential. We believe that people can make better business decisions going forward, knowing what their true costs are. Neil's alluded to it. The difference between the best and the worst was large. It is now becoming extremely enormous. Even in poor years, there are potato businesses making exceptionally good profits while others are losing. What does a farmer do when he makes money? He tends to reinvest it back into the business to make it bigger, and that will be at the expense of them smaller scale producers. Looking to expand on a regular basis, I have seen businesses expand too quickly, too fast, too large. They lose the control because they don't have the management structure in place to be able to manage that growth, nor do they probably have the contracts that give the returns that they may have achieved when they were a smaller business. Please don't assume that all fixed costs are fixed. We have seen businesses expand quite rapidly and fixed costs completely go out of control. Sustainable farming practice, to me, means efficiency. It's to get more from using less. And that's what a lot of practical farm businesses are doing. They're developing the science, they're developing the technology, and they're improving the costs of production to make sure that in a competitive marketplace, they're leaving the greatest margin for themselves. And provide what the consumer is looking for. Neil alluded to that as well. I have seen growers grow potatoes and then hope for the market to come along afterwards. That still happens. And I have seen growers who grow fully on contract and know exactly where the crop is going and exactly who requires it, and with a certain degree of accuracy, know what price they're likely to receive. What do the best do again? They're adaptable. They will change their business model if it doesn't work. There are businesses out there that will continue to operate the same model, whether it works or not, and do expect to get a different result for some reason. If price variation doesn't come, then the results are going to be exactly the same. So do be adaptable. Do find out what's working in your particular business. Find out what others are doing in terms of best practice to change the model that you may be operating. They do know who their competition is. With exchange rates where they are, the return back to your European competitors will be significantly better selling product in the UK than it has done in the past few years. We quite clearly see that as a threat to all sectors in agriculture, and one of the reasons why the returns to agriculture as a whole will be depressed while exchange rates are relatively modest against the euro, or relatively strong against the euro. We do see good businesses collaborate. They work closer together. They'll work as buying groups. They'll work as marketing groups. They get better returns. And what are the best doing? They're simply doing everything that little bit better. Their yields will be better. Their costs of fertiliser will be slightly less. The soil analysis will be undertaken. The labour will be better. There's not one thing that really drives the difference in performance. It is just all the little bits adding up make a significant difference, especially when you bring volume to an industry. Contracts are obviously important. Our best performing businesses tend to have contracts for the majority of their product. As I said before, they know who they're selling to, they know what price they're selling at, and on the whole, they know exactly what their costs are going to be. So they're locking into a profit. When they come back to the bank looking for expansion or further funding, when you know they've locked into a profit, accepting that the quality in the crop has still got to come out of the ground, that gives the bank more comfort to fund that business than selling at spot market, because the uncertainty of returns can lead us to have difficulties in the past. And the last thing I would say is build a strong relationship with your bank and communicate with them. The more you communicate problems, or more that you communicate there may be an issue going forward, you're more likely to get a more positive response. Putting your head in the sand when a difficulty hits only exasperates the problem, and the manager might not be able to resolve the issue if it's gone too far down the line. So again, we like benchmarking to indicate, or budgeting to indicate quite quickly when you're coming off plan. The best businesses who make the best returns are the ones that benchmark and the ones that budget. Thank you.
Our third speaker, who will be presenting the case for the rewards available to an innovative supply chain, and very much our third speaker, Mark Taylor, is at the cusp of an exciting new supply chain challenge. So please, I will invite Mark Taylor, Business Unit Director of International Procurement and Logistics, some people would know it as IPL, to talk to us about the supply chain. Thanks, Mark.
Thank you, Phil. Good morning, guys, or good afternoon now. I need to put this into context, the move to IPL. International Procurement and Logistics, 100% owned by ASDA. We source every piece of produce that goes into ASDA. So quite a big business. I'm new to it. So I spent 25 years running the potato business in Denmark. Some people say I'm now poacher turned gamekeeper. Living on the other side. It's not quite how I see it, but I'll expand on that in a second. So we did the deal as Fenmark and came across mid-January for the assets and the team in Fenmark. We did the same then for the assets from QV for their site in Dundee, and we are now starting to fold back volume into those two sites. So our rationale to create a unique supply chain capability for Asda and Walmart, it's very simple. 100% of what we do, why I get out of bed with my team every day, is to supply Asda. I've got a good track record of doing that. My business as Fenmark was highly dedicated to Asda, and we've continued that theme. To buy directly from growers and create strategic partnerships, again, absolutely essential to how I feel I want to work with my grower base. Having shorter supply chain as possible, direct communication, simple plans, great communication. Planning. Plan. We cannot do enough planning, and the more we talk, the more we discuss, and the closer we get, the more effective we will be. I am not thrilled to be in a business at the moment which is year on year selling less, and it's not my intention to continue to do that, and I am thinking creatively now as regards how we get potatoes full stop into Asda. And again, I'll come back to a little bit of that. Again, so with Asda Focus, it's quite simple. It's giving their customers a great offer. So again, we know why we're getting out of bed. What do we need to consider? One industry voice, I'll just whiz through these and then come back to them. Relevance of UK. We pride ourselves in being a UK-based or focused business, but there are other options as well. Quality and consistency, consumer choice and shopping habits, relationships, and I will repeat myself on a number of times, I make no apologies for it, being in somebody's plan and growing to a plan, again, absolutely core to what we believe in. The rewards, and then the future. I am wearing two hats today as well, so as a board member of AHDB, we have responsibilities to you, our levy payers. We take those very seriously. I am determined that we do speak as one voice. We have a mutual interest in the prospects and prosperity of the potato industry. We might deliver different sectors of that, but we are one industry. I put the red tractor logo up there. I'm a firm supporter of this. I am not a supporter of a plethora of accreditation schemes. They add complication, they add red tape, they confuse the hell out of our customer, which is not what we want. And I prefer you guys to be growing great crops, not filling out pieces of paper. But acting and behaving as one is really important. So UK, really important to us. I'd like to think it's really important to you, but not at any cost. We will always endeavour to put UK product on the shelves. We need to be cost competitive. And I think that speaks for itself. So the major risk, or one of the major risks, and I've bumped into a bit of this in the last 24 hours going around the conference. The worst thing we could do is just carry on doing what we're doing today. So in reality, going backwards at a hell of a speed. So please, I'm not saying that's the case for you guys in the room. I think it is a risk for our industry if we don't really grasp the speed of change that's around us. Quality and consistency. So the RON seal does exactly what it says on the tin, and that's how I feel about quality and consistency. We have to get better at consistency. I think we put some great products out on the shelves. I think we put some indifferent ones. It's the indifferent ones that leave a poorer experience with our customers. And I mentioned this to Graham beforehand, so I put McCain's up there. I think they're a great example of doing what they say and saying what they do. And I think in the fresh sector, we can learn quite a lot to try and replicate some of that into fresh. So the changing customer. This is Kantar. So if any of you were in yesterday listening to Chris, an absolute passion for our industry. We do a lot of work with them, great insight into what the marketplace is doing. So what's it doing? So what does it tell us? So in that 4-year period, the frequency of shop has fallen. More importantly, the average weight in each basket has fallen. We've seen some price inflation, which has masked it to some degree. The underlying story there is we are selling less, and that's not a great place to be. So again, we have a collective interest in getting that right. So how do you feel? How's your relationship? Are you being helped to find a new future, or do you feel you're going to be dropped off the cliff? I've known both sides of that. I know which side I like to be on. And it's your choice. So, are you looking for a one-night stand? Are you looking to live life together? It is very simple. We all have choices. It's how we apply them. So from a rewards point of view, pound notes is very, very important. I get out of bed, and I did do in my old life as Sven Mark, to make money. Excites the hell out of me making money. There is no silver bullet. There is no one contract. As Neil touched on earlier on, cost sets are different. Contract arrangements and how it applies to your farm can be different. Putting structure, I think, is essential. I will not tell you how to run your business, I never would, but having structure and an underpinning of your enterprise, I think, is critical. Central to IPL, my mantra for the last 25 years in how I was working anyway before, deal direct. It helps communication, it provides a clear plan. At the point you are going around the sides of a square or a triangle, that makes it much harder. And it's not easy in all cases. It's something that I will pursue within IPL. And out of that, I think that should drive rewards and value for both us and our supply chain. These have been ably covered without mine, but recognise your costs. There's some great tools out there to help you on this. You have, and I've done enough analysis. I used to, up to going into IPL, of my own production. I've now stopped that. So I know fully the cost of production, the variability in that, the impact of casualty, the risk in the profile of growing crops. But it's essential that you know yours. So this fits in with the contract piece, really. So I'm not now an advocate of one plan or structure fits all. I think we are now at the point where we will tailor this down to individual farm. We will look at any part of the supply chain as regards what it's adding, where it sits, where it adds value, and the rewards that go with that. So I wouldn't like that to become an absolute plethora of arrangements, but there will be a range. Easy to say, harder to do at times. One of the things that I realised, so I came across the line on the 16th of January, the value of certainty is immense. It is for me, it is for my team, it is as regards how I feel about investment and taking the piece forward. And now sharing that with our grower base, I think, has got much more clarity from the point of view of where we want to go and how we want to do it, but a clear plan. So I just touched on that one. As an industry, we cannot afford it. Overproduction and contingency, I'd like to think, is a thing of the past. I don't want to build in slack in any of my plans. You guys are getting a much better at the job you do. We're growing better varieties with better inputs, with better controls, with more surety and certainty. We're not seeing anywhere near the casualty as regards crops that don't make it now that we saw a decade ago. So we have to think about growing the right crops in the right volumes for the right marketplace. This for me sits with the direct communication and direct dealing. There are elements of supply chains where it passes through a number of hands. I am a supporter of any supply chain that adds value. If you're not adding value, it will not sit in my supply chain. And I would urge you to think about that in your own relationships, where you sit and what you do. It's not easy. I feel passionately about our industry and about our future, but we are going to have to make some hard choices. I think we face at the moment potentially too many growers growing too many acres with too much capacity. It's been touched on this morning, the top quartile. It will be to some degree survival of the fittest, and the future is ours to make, but some of that will be quite hard as we go along. So the future for me, continue to develop those relationships. Get them direct if you can. Understand your customer. Let them understand your business. Again, it's a really simple observation, but I'm not sure we've all grasped this. The decline in our fresh sales has been with us for the last decade. I think we've only really started to properly wake up to it probably in the last 2 years and really sort of measure the consequence of that. So recognise your marketplace and recognise it's changing. And I think I think our cycle of change will get faster still. I think you will see more change in a shorter period, and it could be more dramatic. Again, touched on both by Gordon and Neil. Recognise and manage your cost base. We are looking really hard now at simplifying our plan, simplifying our process, stripping out cost in our part of the business. So one of the things I'm looking at now is, so if you spoke to my production manager, he'd say, or he'd make the statement, so what's his ultimate plan? He'd have one variety and one grower, and that'd be really efficient going through the factory. Now we know that's not reality, but we are trying to. So again, thinking about how you plan, how you unload your stores, how you load into your customers, doing that in bigger blocks, in managed ways, drives cost efficiency for both you and that customer. Adding value. We cannot just keep doing what we've done. Look hard at your business, and many you will be recognising this. Where you sit in the marketplace, the value you add. Test yourselves on what you can add to that from the point of view of services and value. Focus on your business. You are all individuals. So both your cost set, how you run your business, how you manage, and your attitude to risk, you are all individuals. So please do not, we are as an industry great, worrying about everybody else. You will not affect their business. They will not affect yours in the main. You can affect your own. Choose your attitude. Do you want to be a cooperative type approach or adversarial? Again, everyone has choices. And again, not one model fits all. And you can think about where you want to sit in that one. I think this is one of the biggest ones. In many ways, our customers are not turning off to potatoes. They're just eating them in different ways. So I think this is as part of change and thinking about this whole risk and reward is understanding, and days like this are great because we share lots of things about where we are. You listen to people with market insight and where that's going. We need to tap into that. We need to think about the pace of change. But we have to respond to those customers. Ultimately, all our businesses depend on it. We need them to go in, have a good experience, repeat that experience, and go back again. And I'm sure you are ready for more change. The journey I've taken my team on has been a massive chunk of change. Did I ever think I would ultimately work for a retailer? No. And I work for IPL and not Asda, but it is a big change. I think you will see more of those coming on. I think other supply chains will look at it through their lens, in their way, but I think it will come. I don't think that's a threat. I think it's a real opportunity for the ones that grasp it. So thank you.
Very much, Mark. Now, ladies and gentlemen, it's your opportunity to ask some questions. So, who would like to ask the first question to the panel? Have you got anybody? Let me kick things off then. One of the things that's changed significantly in the industry is the scale of potato growers. We see the stats every year of the number of potato growers getting smaller, businesses getting bigger. And one of the things I'm very conscious of is that the potato crop forms a bigger part of these people's businesses. So if we go back 10 years, typically somebody was growing a unreasonable arable acreage, and potatoes were part of that, and we now see more specialist producers. How do you think that affects the risk profile and the way those growers need to behave when potatoes are such a big part of their business? Who would like to start? Mark?
Shall I go first? Again, I don't think one model fits all, so I'm a supporter of both ends of that spectrum. Mm-hmm. So I think there are some very good large-scale producers who understand their costs and get efficiency from that. There are people that focus very well and do it exceptionally well on some of the specialist areas. Yeah. So again, I think it's matching your market niche, what you can do as a business. Scale in some cases I've seen go wrong. Mm-hmm. And I think it has to be very careful about sort of growth for growth's sakes. You can lose attention to detail and that focus, and maybe in some cases get a disproportionate amount of risk and casualty if that isn't followed through. So I think there's size to fit all across the marketplace. So again, I think it's just identifying your part.
Gordon, what when you see businesses getting bigger and more specialised, how does that affect the way you treat them, the way you need to assess them?
Well, small and big businesses succeed. It is down to the management of each individual business at any one time. And the businesses that are expanding, businesses are expanding because they're good at what they do, and they're generating the cash and the profit out of the business, and therefore they reinvest back into what is now becoming their core business. And every sector seems to be specialising into bigger and bigger units, but it doesn't always mean that big will be successful. As I said earlier, I have seen businesses expand quite rapidly from sort of 300 acres up to 2,500, but they just lose control. They don't have enough management experience to control that sort of acreage of land, or they don't have the contracts that will give them the margin that they were making on the first 500 or 1,000 acres. So you've just got to make sure that you're controlling the costs. And every good business will tend to have low costs of production, know exactly what they're selling for, and lock into a profit for a majority of the crop that they grow. And the risk from a banking point of view is back to the management. Can the management, in our opinion, manage that business going forward? And what happens if one of the key drivers disappears? How will that business perform if father has it all in his head and perhaps son isn't quite experienced enough to maintain that performance level?
Yes, question in the front row.
In your benchmarking processes,
Yeah.
do you ever
Very good.
Sorry, Neil, in your benchmarking costings, do you apply a figure for risk?
A figure for?
Risk.
Risk. Yes, I suppose we do, in that we benchmark across a period of time. We benchmark at the cost that people build into their business. So risk equates back to a cost. It's not an additional cost. It's the cost within each factor. So within the spray program, we consider, within the machinery program, we consider what would be a reasonable scale to see for each of those things. So that's one side of the equation. The other side of the equation becomes for the grower what level of reward they expect to see for the risk they think they're taking. And I would take the view, for instance, that a long-term storage crop is a riskier proposition than a off-the-field crop, because the long-term storage crop, you've got your money invested for a longer time, there's more time for things to go wrong. So if I was putting a crop into store and investing money for that long, I'd want a bigger return per tonne, a bigger margin per tonne for having done that. So there's different ways of looking at risk, and I think that very clearly for a grower, when they look at their cost of production and then look at their price they're receiving, one of the things you've got to look at is that reward enough for the risk that you're taking. But there's costs built in across the piece, and for an individual grower, that's one of the big decisions for management, is how much cost do you build in. Okay. Thank you. So we've got another one back in the middle of the room.
Interesting that you say that, Neil, because ex-field contracts puts you as a grower at the mercy of getting the bookings to move the crop, which can very much have a negative effect on efficiency. Mm-hmm. Where this year went into a 12-acre field 7 times.
Right.
Now that's phenomenally inefficient.
Yeah,
I agree.
Whereas going into store, we could do probably double the area a day, because we're just not stopped. We're not changing bulkers. We're not at the mercy of bookings that we can get. And it's not getting the bookings, it's keeping them, because sometimes things can change. And it's those things that are out of our control as growers are the most difficult ones to manage. Yeah. And we're seriously considering stopping all ex-field contracts because of the effect it has on efficiency.
I think that's a fair point, and obviously every crop you grow has its peculiarities and its risks. But it's I think both the other speakers mentioned relationship today in talking about risk and reward, and I think again it's one of the things we've got to get better as a supply chain about saying how do we manage those areas, because those areas cause cost. Having men and machinery ready in case they're needed, in case that load does or doesn't get lifted, has a cost to the supply chain and makes the product that we put on the shelf more expensive. So the more we can work cleverly, the more we can organise that and plan it. And that takes both sides, because it takes the buyer needs confidence in the grower that if he asks for the load that it is going to be delivered. The grower needs confidence that if he gets it booked in, it's going to be taken. So that's where the relationship piece comes to me, is how do you make that strong enough that it works. Very good. Was there a question over here?
Yeah, 2012, 2015, the one problem we've had is lack of sunshine at critical growing periods of the year. Now, it's dry, we can irrigate. If it's wet, we can drain. But sunshine, lack of, is quite a serious thing when you don't make the length of potatoes you want, or whatever it may be on the specification. How can you possibly cater for that?
Any volunteers? Mark, can I check? Big lights.
I think we recognise within that. So obviously we can't. So it's that variable of Mother Nature, isn't it? So we can start with a great plan. I think a lot of you are quite fleet of foot, so you can do nothing about something like sunlight hours. You can, from the point of view at times, think about thinking about your variety mix, your land base, how far you can let some of those crops. So again, if you can extend their growing season, again, how far do you take that before you flip over on the risk piece, where there's a greater risk in leaving it there than the last 2 tons you might gain in yield. There's no value in that field if it's still in that crop rather, if it's still in the field. So I think varieties that allow you some flexibility, I think are easy to manage. We have some varieties which are very long season varieties that will always create a peak of activity at the end of the season. So, if we thought this was going to be a longer term trend on a changing climate, I think we'd have to seriously look at what our variety mix was.
Gordon, do you have any?
There's not a lot I can add, really. If the UK is not receiving sunlight, everybody's impacted the same way. So it's back to how do you mitigate that loss? If businesses are losing cash or not maximising their return, what are they doing to try and maintain the loss or the shortfall as small as possible?
I think, I mean, it's a question with a barb, isn't it? And one of the joys and one of the fun of farming is the fact that we deal with nature, and that has its variability in it. But to me, there's also an element where you can manage that risk in managing the crop and the agronomy of it, and saying, well, how do we focus on the fact that we're trying to capture sunlight? How do we make sure the crop reaches canopy size as quickly as it can? How do we make sure we've got the right soil structure, and all of those things? And those things come into that picture, and the person who's more technically able, who manages all those factors, will have a crop that's up and running and gathering sunlight and doing the best for what it gets. So I suppose that's the technical answer.
I have a question for Gordon, if I may. Gordon, you've talked about the importance of benchmarking. From a practical point of view, what sort of percentage of growers that come and see you would actually be participating in benchmarking?
Actually participating in benchmarking, probably around 25%, I would say. More perhaps know an element of cost of production, but probably not comparing that cost of production with what the peer group are able to achieve. So not quite knowing whether they're high cost, medium cost or low cost, but there will only be a low percentage actually benchmarking itself. It would be comparable to what's happening in the dairy sector and the arable sector. The best for benchmarking would be the pigs and poultry, where we would see nearly 100%.
Thank you.
Hi. So, question mainly for Mark, I think. You said earlier you were thinking creatively about how you could actually sell fresh potatoes at all in the retailers. I was just wondering what you feel the retailers' perception or the retailers' perceptions of consumers' perceptions are of fresh potatoes, and is the potato sector in store, is the space that it's justifying under threat, and are we essentially heading for a cliff potentially if that gets cut?
Well, there's quite a few questions in there, aren't there? Are we heading for a cliff? I would like to think not. I think we want to be fully aware that the things are changing. I think from a consumer point of view, and this has been shown out with fairly recent data, consumers are not turning off to potatoes. So we mustn't leave the room thinking that's the case. They are just eating them in different ways. So I think our challenge now is to think about, so it could be the convenience element, it could be the portion size, there may be something in there about waste, and think really hard about the next generation, because our children are eating very differently to us and very differently to my parents' generation. And that is a serious move in how they shop, what they shop, and how they eat it. And as an industry, we must take that into account and then keep pace with it. But the underlying message for me is they are not turning off to potatoes. So this is not about a doom and gloom story. It's just about refocusing the lens.
Well, if that's all your questions, could I please ask you to thank our speakers in the traditional way?